I've already talked about EIS and SEIS schemes. These are hugely valuable for small and startup companies to raise much needed finance through these platforms, and in order to give the investor tax relief of 30 or 50% on their income tax bill, as well as CGT exemptions. So today I'm going to talk about the differences in the qualifying company conditions. There's a lot that are quite similar, but there are differences between the two schemes that we need to be aware of. So firstly, we have conditions that need to be met at the date of the share issue. For EIS and SEIS, there are some similar ones. So for instance, the risk to capital condition that was introduced in 2018 basically means that if an investor is putting money in, there must be a genuine risk that they are going to lose some or all of their money. Obviously, the 30% and 50% income tax relief will give them a big incentive to do the investment and reduce any effect of any losses, but they have to genuinely be putting their capital at risk. The company to be unquoted, but they can be on the AIM market. The company can't be in financial difficulty. Those all apply whether it's under EIS or SEIS. A few differences then, and here's why we see how SEIS is so much smaller for much newer companies. So under EIS, the gross assets you can have when you issue the shares is up to £15 million. After you've issued them, the gross assets can't exceed 16 million. Under SEIS, the gross assets can't exceed 350,000. So we've got a difference from 350,000 for startup SEIS companies and 15 million for EIS. So there's a massive difference in those company sizes. We also have a permitted maximum age. So under EIS, the company can be up to 7 years old. If it's a knowledge intensive company, which has its own set of rules and relaxations in the qualifying conditions, the company can be up to 10 years old. Contrast that with SEIS, which says that we need a new trade, and a new trade means up to 2 years old. So we've got 2 years for SEIS, 7 or 10 for EIS. Now we also have some conditions that must be met for 3 years. So what are the conditions we need to meet under both schemes for 3 years? Firstly, it needs to be a trading company throughout that period. There's certain exclusions, so things like property development can't qualify, legal and financial, accountancy businesses can't qualify. But generally, otherwise, it needs to be a trading company. It needs to have a UK permanent establishment, because of course the whole point of giving such a valuable relief to investors against their income tax and against their CGT is that we want to encourage growth in the UK. So we need a UK permanent establishment, a UK business effectively. We also have a control and independence requirement, which basically says the company can't be under the control of another company. So if we have a group, these shares must be issued in the top holding company. Also, if there's any subsidiaries, they need to be qualifying subsidiaries, which means that the company needs to control those subsidiaries. It needs to hold 51% or more of the shares. So those conditions apply to both EIS and SEIS. Now we do have some differences. Firstly, the use of the funds. So EIS must be used within 2 years. SEIS can take a little bit longer to use them. It's got up to 3 years to use them, because that follows the same period up to the termination date of the share issue. The other element is the fundraising limit, and again here's another example of why SEIS is so much smaller. So for SEIS, the maximum you can raise under the scheme is effectively £250,000. Under EIS, you can raise, there's two separate limits. The first is an annual limit, and you can raise up to £5 million in the previous 12 months. If you're a knowledge intensive company, that doubles to 10 million. So knowledge intensive companies are able to raise a lot more in a 12-month period. And we need to amalgamate EIS and SEIS fundraising for those limits. And then an EIS company also has a lifetime fundraising limit, and the lifetime limit is £12 million or 20 million for knowledge intensive companies. So those are the main conditions for a qualifying company, and you can see from some of those conditions the amount the SEIS company can raise and the total gross assets it can have are much smaller for an SEIS company. As always, like, comment, share. It lets me know that these videos are well received, and if you have any comments or interpretation of this legislation, really interested to hear everyone's thoughts.